Today we're digging into the latest annual report from Helens International. And honestly, it's a bit of a head-scratcher for investors. Their revenue? It took a nosedive. But their profit? It completely turned around from a huge loss. So what's really going on here? Let's jump in and unpack this big strategic pivot.
Here's our game plan. First, we'll get a sense of just how big Helens is. Then, we'll tackle that confusing financial snapshot. After that, we'll break down the massive business pivot that explains everything, peek under the hood at how things are really performing, and finally, we'll talk about what could be next for them. All right, first things first. Before we get into the numbers, you need to understand the sheer scale of this company.
To put it bluntly, Helens is a giant in the bar scene. We're talking about almost 600 locations, making them a huge network across Asia. Now, you got to keep that size in mind because it makes the financial moves we're about to see even more dramatic.
Okay, now for the financials. This is where the story gets really interesting and, at first glance, pretty confusing. So, the first number that just jumps off the page is this one. Revenue is down more than 28%. For just about any company, seeing your top-line sales shrink that fast is a massive red flag for investors. And to put a real number on that, they went from over 752 million RMB down to 539 million. That's a drop of over 200 million in just 1 year. Your first question has to be, what on earth happened?
And right on cue, here's the twist. You'd expect a huge loss to follow a revenue drop like that, right? Well, the bottom line tells a completely different story. And this is the central mystery we're here to solve.
Just look at this turnaround. In 2024, they were bleeding money, a loss of nearly 78 million RMB. Fast forward to 2025, and boom, a profit of 34 million. So how in the world do you manage that? Well, the answer is that this wasn't an accident. It was the result of a massive, deliberate change in their entire business model, a huge pivot. You see, that drop in revenue, they planned it. The company made a conscious decision to shrink the number of bars they own and operate themselves and instead go all in on their franchise business. It's a classic move to an asset-light model. So here's the deal. Instead of taking on all the cost and risk of running hundreds of bars, Helens is shifting to a model where partners, franchisees, run the bars instead. Think of it like this. They're not running the restaurant anymore, they're just selling the brand and the secret recipe. This path to profit had 3 key parts. 1, they shut down their own underperforming stores, which got rid of huge costs like rent. 2, they went on an absolute cost-cutting rampage across the entire company. And 3, they started pushing their own branded drinks, which, get this, have a profit margin of almost 80%.
And when I say cost-cutting rampage, I'm not kidding. Just look at these numbers. They slashed employee costs by nearly 35%. Rent and equipment costs were cut by over 40%. And advertising? They cut that by almost 70%. That's how you flip a loss into a profit, even with falling revenue. So, problem solved, right? They pulled off a successful turnaround. Well, not so fast. Because when you start to look under the hood of this new strategy, some other, more worrying trends start to show up. Now this, for any investor, is a really big deal. Same-store sales, that's the revenue from bars that have been open for at least a year, are down over 18%. That tells you that the existing core bars are actually getting weaker. The company as a whole is more profitable, sure, but the individual locations are struggling. And check this out. The new high-beer partnership bars, the model they're betting their future on, are pulling in way less cash per day. Their average daily sales are almost half of what the older bars were making. That's a huge difference. So the big question is, why does this matter so much if the company's profitable? What's the real story here for an investor?
What this all boils down to is a strategic trade-off. Helens has very clearly decided to sacrifice high growth and strong performance at the individual store level. In exchange, they get better overall profitability and a much less risky business model. It's a choice, but it's one that comes with consequences.
So, with all that in mind, where does the company go from here? What are the risks they're facing, and where do they see opportunities to grow? Well, the company's management is pretty upfront about the risks. They know they have to keep up with changing trends, protect their brand from knockoffs, and they're always exposed to things like health scares or an economic slump that could hammer the whole industry. And their plan for the future? Well, it looks like they're doubling down. They want to expand that high-beer partnership network even more,
tighten up their supply chain, and start exploring new store concepts to keep things fresh for their customers.
And this quote from their report gives us a clue about their big picture thinking. They're talking about becoming a third space. You know, not home, not work, but somewhere else people go to connect. It's a great vision. The big question for investors is, can they actually achieve that vision when their individual stores are showing signs of weakness? Only time will tell.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.